Hello, this is Elena Ferguson, and in this video for Accounting 201, I'm going to go over our very last chapter. In this chapter, the title is Financial Statement Analysis, and that's exactly what we're going to do. So, the very beginning of the semester, you learned that there are financial statements, that there are 4 basic financial statements that we prepare, and we prepare them based on the numbers that we have accumulated with preparing transactions, right? So we learned about day-to-day transactions. We learned about adjusting journal entries. We did a lot. And now it's time to look at the numbers. What do they tell us? How do they help us to make good decisions either within the company, or this class we focus quite a bit on outside of the company. So we basically, shareholders or stockholders, they're looking at the company trying to determine if it was a good investment. If it's a healthy company, if projections show based on what the company has done, we call that trends. If we think this company is going to continue to grow, not grow, or fail, right? So, okay, so a couple of things. First of all, we're going to go over some ratios. Now, we have done ratios throughout, so this isn't completely new to you. But we're just going to kind of bring them all together. In your chapter, there's a great couple of pages listing out all the different kinds of ratios. There's 2 categories that we're going to look at right now. There's risk ratios and profitability ratios. So this company that we're looking at is Virtual Gaming Systems. We've been given their income statement as well as their balance sheet for the year for 2 years. So this is a comparison. For the income statement, I've got 2 years, and the balance sheet actually is 3 years. So now in order to look at trends, so what we mean by trends is what happened in a prior year, what's happening in this year. And that way we can kind of see, okay, year 1, year 2, year 3, year 4, we can see a trend. We can see kind of a movement. Are we increasing? Are we kind of staying put? Are we decreasing? So in order to do that, we have to look at these kind of financial statements where we can see multiple years, right? But the years are shown kind of opposite of the way we would think, right? So the old year is shown or the new year is shown first, and the old year is shown off to the far end. So the oldest year, normally when you read from left to right, so you would think it would go old to new, but it actually goes new to old. So kind of interesting there, right? So you're gonna have to remind yourself. It's almost great to talk out loud for these ones. Okay, so the first set of ratios that we're gonna do are risk ratios. So we'll do a receivables turnover ratio, and let's start with that one. So for the receivables turnover, what we're looking at, so we'll kind of label these, and you know what? I'll still write them out. That way we have them written out. Okay, so turnover. What is turnover? So turnover tells us the life cycle. So if you think about receivables, what is the normal life cycle for a receivable? So I'll kind of zoom in up here. So the normal life cycle would be that someone charges on account, and so that establishes an accounts receivable. We provided a service or sold something. So there's an increase in accounts receivable, and then we collect it. So at some point, the turnover basically goes from increasing the account to collecting the account to 0. That would be the turnover. So what we want to see is this turnover to happen many times throughout the year. That would tell us that we're collecting our accounts receivable many times throughout the year, right? So receivables turnover ratio is taking net sales and dividing it by average accounts receivable. And I'm going to abbreviate accounts receivable there. Okay, we're going to have 2 years that we're going to keep track of this. We'll do year 1, or the first year, 2024. It's the prior year. And then we'll do 2025. There we go. Okay, so we are given net sales. That's a pretty easy one. However, we're not given average accounts receivable. So let's go to accounts receivables on the balance sheet. So let's go up to the balance sheet here and take a look. So we're given the accounts receivable balance. And if you remember, and I know we've done this before, I believe, if you remember, average is when you take beginning and ending and divide it by 2. That will tell us on average what was the balance in accounts receivable. So just quickly looking at this, remember prior year. So I think we did green for 2024. And then what did I do? Red. So prior year, current year. So when I'm looking to do 2025, I want to know the average. I look, the end of the year balance was 90,000. The beginning of the year balance is 91. Now wait a minute. I just said beginning of the year balance for 2025 is 91,000. And that's correct, because what I'm looking at right here is that this is the ending of 2024. So this tells me December 31st of 2024, the balance in accounts receivable was 91,000. So if it's December 31st, 2024, that's basically the same as saying the beginning of the day, January 1st in 2025. So do you see how that's my beginning balance, 91,000, and my ending balance for 2025 is 91,000. So we take basically the prior year balance, that's our beginning balance, and our current balance, and then divide by 2. All right, so we're going to do several averages, and so I'm just going to use this entire area off to the side to do our averages. And let's just write that out again. Remember that to calculate average, you would take beginning balance plus ending balance, and then you would divide that by 2. That gives us an average. Okay, so let's start with accounts receivable. And I'll do 2025. So 2025 for AR, if I take the beginning balance, it's 91,000. And let me make a note on that. So remember, the beginning balance of 2025 is actually the end 2024. And then, of course, the next number, which is the end of 2025, right? Okay, so let's put that in here. 90,000. So 90 plus 91,000, and then divide that by 2, and you will get, do I have enough room? Good, I do. You will get 90,500 as the average accounts receivable for 2025. So average AR 2025. All right, let's do the same thing for 2024. So 2024 accounts receivable, we'll take the beginning balance, which would be the end of 2023. So I'm going to take the 70,000. So this is end of 2023 is my beginning balance. Okay, and then I'll add that to my ending balance, which is the end of 2024. Sorry about that. And we'll add those two together. And then, of course, divide by 2. And we'll get average accounts receivable for 2024 of 80,500. Okay, so we calculated the average accounts receivable. And we're going to do more averages here. So I'll just block this off. This will be our area for that. And then the other number that we needed was just the net sales. So net sales is given here at the top of the income statement. Net sales is basically sales minus any returns, allowances, discounts, all that good stuff. Remember, gosh, I think we learned that in chapter 5, it feels like, maybe. I'm not sure now. Maybe chapter 6. All right, so moving back over to our page where we're calculating this. All right, so let's do the old year first. So 2024. Net sales for this problem is 3,086,000. That's our net sales. And we're going to divide this by average accounts receivable, which we just calculated was 80,500. So you'll get an answer in your calculator of 38.3354. And when we read the instructions here, it does say, oh, there it is. It does say to round your answers to 1 decimal place. Let me fix that. It's kind of heavy. Okay, Okay, we're going to round our answers to one decimal place. And when we get to the percentage, I'll teach you that one. All right, so the answer would be 38.3 times. 38.3 times. So that's pretty good. Now, we compare that to other companies within the same same size and same area of expertise. I forgot what this was, virtual gaming. So other gaming companies, right? Okay, so for 2025, what does it look like? Again, net sales. So for this one's a little bit higher. It's 3,560,000. That's our net sales. And we divide that by the average accounts receivable, which was a little bit higher. Makes sense. If your sales are up, your accounts receivable is probably up. So we're at 90,500. And that gives us 39.33702. So we're going to round this to one decimal place. It's 39.3. So we're doing a little bit better. Remember, turnover is a good thing. So the higher it is, the better. It means we're collecting quite a bit, right? So the life cycle of receivables means customers charge, we collect, customers charge, we collect. So as that happens, we want it to happen. We want it to happen several times. If it's only happening a few times a year, that's not good, right? We need to be collecting at least once a month. That's every 30 days. Obviously, this company is doing even better than once a month. They're doing even better than twice a month. So they're doing great. All right, the next one we're going to do is our inventory turnover. So another asset that we're going to look at is inventory turnover. And inventory, the life cycle of inventory would be you purchase it and then you sell it, right? So the turnover for this one would be to take our net income and divide it. I'm sorry, not net income. I got distracted. The dog just barked and I was kind of thinking, I wonder what she's barking at. Anyway, cost of goods sold. What happens to, let's draw this out too. So the life cycle for inventory, you purchase it, right? It becomes inventory. So you buy it. And the life cycle would go all the way around and it becomes what? Cost of goods sold. So what we're going to look at here, inventory goes up, cost of goods sold eventually goes up, two different kinds of accounts. So what I have is cost of goods sold, I'm going to abbreviate that, divided by my average inventory. So we need to do another average calculation. Not a big deal. All right, let's go to that prior page and do our average calculation over here. Okay, so for inventory, what it looked like for this company, I'm going to highlight these numbers so we can see them. 140,000 is the 2025 balance, 115,000 for 2024, and 145 for 2023. So I'm going to need all of those numbers. And let's write them out over here. Again, beginning and ending, divide by 2. It looks like I did the current year first last time, so we'll just keep with that same idea. 2025 inventory. So if I take the beginning balance of 2025, which is the end of 2024. Again, beginning balance of 2025 is the end of 2024. So I start with beginning balance, and then I add ending balance. Ending is ending, right? And then I divide all of this by 2. Not giving myself enough room here, so we'll zoom in and see if I can write a little bit smaller. Okay, so my average inventory here, it's going to be somewhere between these two numbers. So it looks like it's 127,500. That would be average inventory, and I'll still label 2025. Okay, so for the 2024 inventory, I'm going to take the beginning balance, which is the prior year, 2023 ending balance. So the end of 2023 is the beginning of 2024. The end of 2023 is the beginning of 2024. And I'll take then the end of 2024. So I take beginning and end and divide by 2. And again, the number should be somewhere between these two numbers, my answer, and it is. It's 130,000. That's my average inventory for 2024. Okay, are you feeling, hopefully you're feeling pretty good with calculating averages. So those two numbers we're going to take over here, back to this page. Cost of goods sold, I didn't, let's go back. I didn't even highlight that. Cost of goods sold for this company, of course, comes from the income statement, correct? Let's see. Right here from the income statement. So cost of goods sold here is, I got the wrong pen. I'm so sorry. Okay. 2,490,000 in the current year. And then the prior year is just under 2 million. So those are the two numbers I need for cost of goods sold. So I'll come back over here to where I'm calculating these and let's put them in. All right, starting with the prior year, cost of goods sold for the prior year, it was just under 2 million. I think it was 1 point, let me look at my notes here. I don't see it. There it is, 1,960. That's my cost of goods sold. And I'm going to divide that by that average inventory I just calculated for 2024. It was $130,000. $130,000. I'll fix that. Okay, when you divide these, you get 15.07692. We're going to round that to 15.1 times. So throughout the year, a little bit more than once a month, because there's 12 months in a year, so a little more than once a month, I'm turning over my inventory, which means I'm buying it and I'm selling it. So about once a month, it's about 15.1 times. And you can divide that and find out how many days. I don't think we actually are asked to do that, but there is a calculation. It's the number of days in a year, right? So we just would take this 365 days, figure out how many times. It's about every 24 days. So, all right. For 2025, the inventory, the cost of goods sold, let's start with that number. The cost of goods sold is $2,490,000. So our cost of goods sold is a lot higher. And our average inventory, do I have that right? Our average inventory actually is lower. It sure is. It's 127,500. So our cost of goods sold is increased by quite a bit. And then we actually decreased our average inventory. So I'm looking at this and we have turned over our inventory a lot more, 19.52941. That's enough there. So 19.5 times. So we're doing really well. If we look at the trend that we're doing from one year to the next, we are increasing. So receivables, we're collecting more. Inventory, we're turning over faster. It's looking really good. Okay, the next ratio is the current ratio. I know we've done this before. We just have to do a little bit of work in order to make this one happen. So if I go back to the balance sheet, remember for a current ratio, what we would need to do is take current assets and divide them by current liabilities. So I'm going to erase my highlight mark here. So first thing we need to do is figure out what our current assets total. So this is my current assets. It's right here with the assets. Current assets, there are 4 of them. And what I need to do is total them up because it's not totaled here. So if I total these current assets up, those 4 added up together equal $461,000. So that would be current assets. Now for the prior year, I would again add these up. And this time I would get $415,000. Again, current assets. Okay. Now what we need to do is do the same thing for current liabilities. So current liabilities, they're listed right here. There's 3 of them. So for the prior year, for the current year, let's do the current year first. For the current year, current liabilities would be $186,000. I'm going to abbreviate this one. And then for the prior year, current liabilities would be $104,000. Now I'm not totaling up here 2023. The only time we need 2023 is if we're doing an average. And we're not doing an average for this problem. We're just going to take current assets and divide it by current liabilities. And what that tells me is if I have enough current assets, those are kind of like money, not quite money, but they could be easily converted to cash, and then divide it by my bills, my current bills, which it looks like I've got accounts payable, interest payable, and income tax payable. So, all right, let me write this one out. I hadn't wrote it out yet. So this is number 3. Current ratio. Remember, we also learned what an acid test ratio is, which is a little bit better because it doesn't take into account our investment, or I'm sorry, our inventory. That's the big one. All right, so current assets divided by current liabilities. This is the current ratio. It's probably the most common one. I don't know if it's most commonly done, but it's most commonly known. All right, so these are all dollar amounts. I didn't label them, but that's okay. All right, current assets for 2024. Current assets were $415,000 and current liabilities $104,000. So when you divide these up, you get a number that looks like this, 3.990385. And what we're going to do with this is we're just going to round it to one decimal place. So 3.9, because there's a 9 after it, it actually rounds to 10, which makes this 4. So the current ratio is 4.0 if you want to include that. Basically means for every $1 of liabilities, I have $4 of assets. So that's pretty good. That's really good. All right, let's look at the current year. So what we have for this year is $461,000 in current assets and current liabilities. So we went up in current assets, we went up in current liabilities, $186,000 for current liabilities. So we end up with 2.4784. We don't have to keep going because really we just need one decimal place. So 4. Did I write that right? Yep, 2.47. Yep, so 2.5. Yes. Myself a little confused. My notes aren't great. I wrote them all over the place. Okay, 2.5. So our current ratio went down. In the big picture, that's not good, right? So we want our current ratio to be healthy and strong. Really, to be honest, as long as it's over 1, we're doing okay. Obviously, any higher is better. Some people would argue that too high of a current ratio is not good. It means we should probably invest our money in something else. So I'm not sure if I want to say this is bad or not. It means maybe we've increased investment somewhere else. But the point of it is it's still positive. So we're still above 1, which is very important. Okay, the next one is debt to equity. So the debt to equity ratio is exactly what it sounds like. It's when you take debt, which is total liabilities, and you divide it by your total equity. So total liabilities divided by total equity. And unfortunately, we do have to add these up on our own. So let's go back to that balance sheet and we'll zoom in here. And if we were to add up total liabilities, let me move it around a little bit. We already totaled current liabilities, but if we were to total all liabilities, it would be not only these 3 current ones, but also that note payable. And then, of course, if we were to total our 2 equity accounts, what are they? So I'll write those totals off to the side. So for total liabilities, we're looking at $636,000. So this would be total liabilities. That's for the current year. And then $436,000 for total equity. I'll just put an E. Okay, now same thing over here. Let's total up all of my liabilities and all of my equity. So we'll write these ones off to the side. Total liabilities for this one, $399,000. It's quite a bit different. So we must have taken out a liability, a big note of some sort. And then equity, is going to be $547,000. So I'm just totaling those two accounts up. All right, now we're going to take those totals over to the other page here and plug them in. Okay, so for the prior year, we'll do that one first. There we go. Total liabilities for 2024 is $399,000. And then total equity was $547,000. When you divide those, you get 0.729433. Now I'm going to tell you, this one needs to be in a percentage. So the first thing I'm going to do is convert this to a percentage. So I'll move it over 2 decimal places, and now it's 72.9433. Now I will round it to 1 decimal place. So now it becomes 72.9. So I'm going to make a really big note here that we need to convert to decimal before rounding. And we'll do that again in our next ratios. So you'll get lots of practice with that. Okay, so the answer for this one is 72.9%. Can't quite get myself to move very good up here. Okay, 72.9% we'll put up there. All right, now let's calculate it for the current year. So I know that we had an increase, a really big increase. So we must have taken out a loan. I didn't actually look closely at that. What does it say? Yeah, notes payable went up quite a bit. It went from less than $300,000 to $450,000. So we took out a loan of some sort. So our new total equity is $636,000. And we're going to divide that by total equity of $436,000. Also, what went down is probably something in retained earnings. Yeah, I think our income went down quite a bit. So there we go. Let's take a look. What does it look like? It's 1.458716. That's probably enough. Okay, now we convert it to a percentage. 1.45.8. Oh, hang on, not 1 point. We move the decimal over so it becomes 145.87. And that becomes 145.9%. So that's not good. Anytime you're over 100%, it means you have more liabilities than you have equity. So that's not good. Kind of like that current ratio. We want to have more assets than liabilities. And here we want to have more equity than liabilities. So company's not doing good in that ratio. Okay, so those were a lot of risk ratios. Now let's take a look at the profitability ratios. So risk ratios, we looked at a lot at the balance sheet. Did you notice that? We spent a lot of time on the balance sheet. We mixed it around quite a bit still. We still use some sales and cost of goods sold because we're looking at inventory and accounts receivable, right? This time, we're going to look a lot more at the income statement, still using some of our balance sheet as well. Now for this one, we're rounding to 1 decimal place. But again, just like I noted a minute ago, anytime that we do a percentage, so for our percentage ones, first convert to a percentage, then round, okay? Because otherwise you won't have the correct number, and you'll see. Okay, so for our first one, we're going to do the gross profit ratio. So gross profit ratio is when we take gross profit. Gross profit, don't forget, that is when we have sales minus cost of goods sold. So for our gross profit ratio, and we'll do a column again for 2024, and then we'll do a column for 2025. Okay, so the gross profit ratio, let's finish writing that one out. So when you take gross profit and you divide it by sales. So basically trying to figure out how much after I take care of the cost of the goods sold, how much do I actually have? And it will be in terms of a percentage so that I see it for every dollar. So for 2024, and these numbers are just given in the income statement. So if I go back here, I'll zoom in here to the income statement, you can see we're given the sales amount. Of course, we're using that quite a bit. So I'll just go ahead and highlight that right now. We're going to be using the sales number, and we're given the gross profit. So we're really just taking those amounts and dividing them up so that we can see what percentage. Now we haven't got there yet, but when we do a vertical analysis, we end up with a gross profit ratio. The number that we calculate right here in our vertical analysis is the gross profit. So, all right, so let's go back here and let's throw these numbers in. So for 2024, our gross profit was $1,126,000, and our gross sales is $3,086,000. So we end up with 0.364874. So we'll round it, or we'll convert it. Convert it first, and then we'll round it. So I'm looking at 36.5. So for every $1 of sales, I end up with gross profit of 36.5 cents. That's what that means. Okay. Oh boy, I did not give myself enough room for 2025. Oh, let me move this around just a little bit so that we have a little more room. Okay. All right, so I've got a little bit more room now, and I can put in my gross profit and my sales. Oops, I need another zero there. Okay. And I end up with 0.300562 converts to 30.05%. So because of that 5, we're actually going to round this to 30.1%. Gross profit went down. That is not good. That is not good. So we're not doing good on our gross profit. All right, so let's take a look at our next ratio, our return on assets. Okay, so assets are expensive, right? So buying machinery and all that good stuff. At some point, we have to determine, are we making enough income to justify these assets that we have? So what we'll do is we'll look at net income. That's the bottom line number, you know that. And we'll divide it by average assets. Now, did we already do average assets, or is that one that I still have to calculate? I think I still have to calculate that, but don't worry, it's our last one. Let's go back to our balance sheet here, and let's put in our average assets here. Now, we do have total assets. They are given. It's one of the only totals we're given. It's right here, total assets. So I'm going to need all three of them. And what we're going to do is we're going to take those, again, we'll take the beginning and ending, divide it by 2, and that will be our average assets. All right, so let's do 2025. These are assets in total. So this is going to be a much bigger number. So for 2025, the beginning would be the end of 2024. So I'm going to start with 946,000, and I'll add the current year, which is 1,072,000, and then I'll divide all of that by 2. And my average assets would be 1,009,000. So that's my average assets for 2025. Okay, so now let's look at the 2024 assets. If we take the beginning, which is the end of 2023, end of the prior year, and add to it the end of this year, and then divide this by 2. My average assets is 870,100 for 2024 average assets. Okay, that looks pretty good. All right, so I've got my average assets. Also for this ratio, we're going to need net income. It is given. So net income is the top or the bottom, sorry, of the income statement. And this was pretty big. I noticed it earlier. I don't know. I don't think I had a problem yet with it. I probably just noticed it when I was prepping. Look at how much net income changed from last year to this year. So I already had a feeling that our profitability ratios are going to look kind of rough, right? I kind of had a feeling. So, okay, let's go to those. All right, return on assets. So I'm going to take the net income, divide it by average assets. So for 2024, net income is 139,000. And then the average assets, 870,100. And when you divide those amounts up, and these are all amounts here, we get 0.159752. Convert that to a decimal, it'd be 15.975. It keeps going. So it's actually going to round to 16% for this one. So the return on assets is 16%. Now, how does that compare? So if I look at the current year, I know my net income is much smaller. And I divide this by a, unfortunately, higher amount of average assets. I end up with 0.032. So when you convert this, it's 3.27%. Oh my goodness. It's really gone down. So we're going to call it 3.3 when we round it to one decimal. And it's not good. This is really decreased quite a bit. We went from 16% to 3.3. So not good at all. Okay, so it's not going to get any better from here. I'm just going to be honest with you. The next one is profit margin. Profit margin is when we take our net income and divide it by sales. So another one that we would see if we were doing the vertical analysis. So I'm about to teach you the vertical analysis, but basically, for an income statement, it's when you take any one of these numbers and divide it by sales. So when we do the vertical analysis and we end up with a percentage number here, this number that we get is actually our profit margin ratio. So we're kind of calculating our ratios at the same time that we're doing our vertical analysis. So okay, so those numbers are just given, nothing to calculate here. Just take net income and divide it by sales. We've actually looked at these numbers already, even just now today. So 139,000 divided by sales of 3,086,000. So we end up with 0.045042. When you convert that, it's 4.5%. And that is really low. So that's basically saying for every $1 in sales, you're going to end up at the bottom line, your bottom net income number, 4.5 cents. 4.5 cents is what you're going to take home. Now that's not as bad as the current year. So when we look at the current year number, taking net profit and dividing it by net sales, this number gets even smaller. So we end up with a decimal, so 0.927%. So we basically, when we round it to one decimal place, it's 0.9%. That's terrible. That's not even a penny. That's not even a penny that you're coming back with. Every $1 sale, you end up with 9/10 of a penny, a portion of a penny. So we kind of already knew that was going to happen, but oh well. All right, the last one we're going to look at is asset turnover. So this one mixes our balance sheet along with our income statement. So let's just take sales and divide it by average assets. We already have all of those numbers. So we're going to take sales, 3,086,000. We're going to divide it by average assets. We calculated that to be $870,100. So this is a turnover. So we're not converting it to a decimal. So 3.546, that's enough for us to know it's 3.5 times. Now, of course, you might have suspected that this year is going to be worse, right? The current year. But believe it or not, let's take a look. I'm already looking at the answer, so I'm kind of cheating here. But let's take, again, the sales, divide it by average assets, and you'll end up with a similar number. 3.5. 3.5. So, okay, so this company, these are just a few snapshot of the profitability ratios, but there are more stockbrokers and financial analysts. They look at these numbers and they look at these ratios daily. This is how they make their projections. This is how they determine buy or sell ratings. If you're at all involved in the stock market, the people behind the scenes that are giving you advice, this is what they're looking at, right? Now, of course, it's not just stockholders that look at these numbers. Owners within the company and executives within the company are also going to be looking at these numbers. So our board of directors, our executives, anybody who has a stake in the company, whether they own shares of stock or they just want to see the company be successful, they care about these numbers, right? Okay, so there's our ratios. Now looking at our vertical and horizontal analysis. Okay, this is a new company. This is Federer Sports Apparel. And what we would do for this company, we're given a little snapshot of the balance sheet, which is great. We could be given an income statement, but for this particular problem, we were given a balance sheet. Not a big deal. Okay, the instructions at the top, we're first going to do a vertical analysis. So vertical is exactly what it sounds like. We're going to be going up and down. So we're going to go just looking in one column at a time. So you'll see it's already set up where I can see this is 2025. And what I'm going to focus on is just this area, vertical. I'm going to go up and down. And then when I switch over to 2024, I'm just going to focus here on these sets of columns. So I'm going to go up and down vertically. Okay, so that's one way to look at it, right? Now for the balance sheet, and they did give us the information, they say that this is for the balance sheet. We're going to do this as a percentage of total assets. So when you do a vertical analysis, you're always taking some number, some account balance of sorts. So whether it's an asset, a liability, or if we were doing an income statement, maybe it's an expense. You're going to take whatever line item you're looking at. So the account balance of that line. And you can think about it in terms of a line. And you will divide that by the base. And the base that they've given is total assets. They want us to do it of total assets. Now, they could have said total liabilities and equity, and it would have given us the same answer. Or if we were doing an income statement, they would have told us total sales. That's typically what we divide by for a vertical analysis on an income statement. Okay, so really quickly, I'm going to tell you, this takes quite a bit of time because you're going to take every number and divide it by total asset. Every single number on here and divide it by total asset. I will show you in Excel in just a minute how to do this so much faster. But first, let me just go through a couple. That way we have a good idea. So let's just label this one a small letter A. Okay, so for this one, letter A here, this is for cash, so you can even label it cash for 2025. What you would do is you would take the balance, like I said, the account balance. So you see it's 2,300,000. And guess what you're going to divide it by? You're going to divide it by total, I'm going to highlight this, total assets. That is going to be our base. So that is what we're dividing everything by. So total assets, 15,600,000. So the answer here is 0.147. These are all going to be given in percentages. So I'm going to write just one more number there. I'm first going to convert it to a percentage. So it's 14.74%. Then I'll round it to 1 decimal place. So we're going to call this one 14.7, and I'll add the percentage sign there. Okay, so that was worth noting at the top. So it says to round to 1 decimal place, but what we have to remember is first convert to a percentage, then round to 1 place, okay? All right, so that is our first one. Okay, next one, accounts receivable, letter B. So for this one, you would take the balance in the account, 1.5 million, and guess what? You're going to divide it by 15.6 million every single time. And I know we've already practiced converting and moving this over, so we know it's going to be 9.6%. All right, feeling pretty good? Let me show you a couple tricky spots. Okay, let's start with accumulated depreciation, letter C. So let's do that one. Now this one is negative, so that's why I want to use this one. So I've got a negative 2 million, that's my account balance, and I'm going to divide it by 15.6 million. So every time, look at that, every single time I'm dividing it by 15.6 million. And that's because I'm in this vertical area, right? So, all right, when you divide this in your calculator, a negative number divided by a positive number will give you a negative answer. A negative number divided by a positive gives you a negative. Now, 2 negatives give you a positive, but in this case, it's one of them is negative. So I'm going to end up with 12.82% negative, or 12.8 is what we're going to use for this one. Negative. Okay, now I didn't do the ones between it, but I'm just going to put the answers in here. I'm going to show you Excel in just a second. So I just want to have the answers here, but this is what it would look like. Now, when I move on to the liability section, I'm still taking these numbers, so 1,450,000, I'm still dividing by 15.6 million. Same number. I'm still dividing by 15.6. So for that one, this is how I ended up with 0.0929, which is 9.3% rounded. So it rounds to 9.3. Okay, now I didn't fill in the total asset area because I just want to talk about it for a second. So if I take 15.6 million, which is total assets, and divide it by 15.6 million, your calculator should give you this, 1. Maybe it gives you 1 and some decimals. But what we have to remember is that the number 1, or the answer being 1, convert it to a percentage, is 100%. So for total assets, and if you do the same thing for total liabilities, you're going to end up with 100%. Right? All right. Now we would do the same thing for 2024, and this time we'd be dividing every number, this time, let's use another color, by 14.7 million. So if I were to do cash, and we'll label this one letter A, capital A, I would take 800,000 and I would divide it by 14,700,000. So because I've switched to a different year and I'm doing vertical analysis, I'm only looking at this year. So this is how I end up with 5.4%, right? 5.4%. And you continue on with this one. Let's look at, especially this one, we'll call this one the big letter C. So I did A, and now we'll just do a little one for, or big one for C here. It's a negative 1 million divided by 14.7 million. So a negative divided by a positive, my result in your calculator gives you 0.06803. It's negative. So that gives us 6.8% negative. Very important that we remember those positives and negatives. Okay, I'm going to put these percentages in, and I will show you in Excel how we could quickly get these percentages. I know for your homework assignment, you'll be doing them as well. All of these are percentages. And 100% on the bottom. Sometimes when I do my percentages, well, every time when I write it gets sloppy on here, so I always feel bad adding more to it, but there we go. Put those in. Those are all percentages. Okay, when you enter them in Connect, you don't have to put the percentage sign because it's the top of the column shows it. Okay, so that is a vertical analysis. Now let's look at a horizontal analysis. So for same problem, same numbers, we are asked to do a horizontal analysis. For a horizontal analysis, you are looking side to side. So vertical was up and down, right? And now we're doing horizontal, so we're kind of looking side to side. So I'm not just looking at 1 year. I'm not just looking at 2025. Now I'm going to be looking at the prior year compared to this year, and that will get me my horizontal look, right? Okay, so they ask us to use the 2024 as our base year. So basically what we're going to be doing is we're going to be taking the increase or decrease, which we call the change in, right? So the change in the account, and we'll divide it by the 2024 balance. Okay, so let me show you what that looks like. It's, again, pretty simple. So we're given a column that says increase or decrease right here. And this, here, circle it right. This would be just simply taking the 2025 number and subtracting away the 2024 amount. So for my very first one, it's the only one I'm really going to show you. It would be, let me do this in black. It would be taking the 2.3 million and subtracting the 8 million or 800,000, sorry. So I would just subtract those numbers and I end up with 1,500,000. Now all you do with that number, so that's the increase or the decrease, you just take that number and divide it by the base year. The base year is 2024, so it's 800,000. So let me label that up here. So again, we take the difference and we divide it by the 2024 balance. And then in this case, the answer is 1.875. Now we need to convert this to a percentage. So it's 187.5%. 187.5%. I'm going to zoom in. We don't really need to see. This is the cash. So 187.5%. That tells us how much it's increased. So because it's a positive number, I know it's increased. Now let's look at the next one. The next one, it's 1.5 million. It's accounts receivable. That's the current balance. And I'm going to subtract away from it last year's balance. And I end up with a negative number, $700,000 negative. That tells me that the account has decreased. So remember, this is the old year and this is the new year. And what I see is that the old year was 2.2 million. This year's 1.5 million. So yeah, it decreased by 700,000. So just like we learned a second ago, I've got a negative number divided by, and we'll divide it by the base year, which is 2,200,000. I'm going to end up with a negative answer. I'm going to end up with 0.3181, and it's negative. So I'll convert that to a decimal and move it over 2. So it becomes 31.8%. Don't forget the negative sign. It's negative. So that number is negative. Okay, so that's all you do. You take the difference between the two columns, subtract the 2, so I end up in this case 1.1 million, positive difference, and I divide it by the base year, which is 1.7 million, and I'll end up with 64.7% positive. Now for this next one, which is the buildings account, it didn't change. Leave this one blank. So we've got no difference, basically 0, and you can't divide 0 by anything, so just leave that one blank. Now this one, let's talk about this one. This is accumulated depreciation. So it's negative 2 million. It was negative 1 million. What happened mathematically is that we had an additional negative 1 million. It decreased by a million. We went from 1 million negative to 2 million negative. So you see how we went deeper in the hole? We went from 1 million negative to 2 million negative. So we went down by a million. Now, when you take this one, what you're going to do is you're going to take negative a million and you're going to divide it by the base year. The base year is also negative 1 million, right? See that? When you take two negative numbers and divide them, your answer will be positive. So your answer is going to be 1, which will convert to 100%. But it's positive. Two negatives are going to result in a positive number. Okay. So the rest of the way down here, pretty simple, just subtracting the new year and the old year, and then dividing it by that old year, and you'll end up with these amounts. Now again, we've got a negative number, but we divide a negative by a positive number, and this is how we end up with a negative percentage. And a negative percentage just tells us that it's decreased. So it's decreased by that percentage. We have another one that's no change, so we'll leave that one blank. And then you'll see that total liabilities and equity, these two should agree. These two should be the same because they're the exact same line. Okay, now I'm going to show you how you could do this in Excel so much quicker. And I'll teach you a little extra with Excel, so it's worth a watch.